If you strip away the noise, the forecasts, the excitement, and the fear, investing has always come down to one simple question. What is real and what is merely promised? Markets have a remarkable way of distracting us from that question, especially late in a cycle like this one. Prices move, commentators argue, and headlines change daily, but the underlying math never does. Gold, silver, and oil are not stories of speculation. They are signals. They are quietly telling us that the value of money is changing, that the cost of living is being reset, and that confidence in neighbor claims is thinning at the edges. This is not about timing the market or chasing the next trade. It's about understanding what the system itself is communicating. In my experience, investors get into the most trouble when they confuse complexity with intelligence. The truth is usually far simpler and far less comfortable when currencies lose discipline. Real assets don't soar. They stand still while everything else slips backward. And when energy prices rise alongside precious metals, that's not coincidence. It's confirmation. So before we talk about where gold, silver, and oil may go in 2026, we need to talk about what they represent. Because if you understand that, the rest becomes not a prediction, but a conclusion. Most people think gold and silver are going up because something good is happening. They look at the price and assume opportunity, excitement, profit. But that way of thinking misses the truth entirely. Gold and silver don't rise because wealth is being created. They rise because wealth is being destroyed somewhere else. When you see metals moving higher, what you're actually witnessing is the slow, steady erosion of currency value. It's not that gold is suddenly worth more. It's that the currency you're measuring it in is worth less. Currencies today are no longer backed by productivity or discipline. They are backed by debt, promises, and confidence. And confidence is a fragile thing. For decades, governments have expanded money supply far faster than real economic growth. They've normalized deficits, monetized debt, and turned emergency measures into permanent policy. That doesn't show up immediately at the grocery store or the gas pump, but it always shows up eventually. Gold and silver are simply the scoreboard. What makes this moment different is scale. Never before have global currencies been created at this pace, in this volume, with this level of coordination. When every major economy chooses the same solution, print, borrow, night, there is no safe paper currency left to hide in. Gold doesn't belong to any government. Silver doesn't answer to any central bank. That independence is exactly why they respond first when faith in currency weakens. People are told inflation is under control because the numbers say so, but those numbers are adjusted, managed, and redefined. Real inflation is what you feel when your paycheck buys less, your savings are nothing, and your future becomes more uncertain. Gold and silver track that reality, not the official narrative. They reflect the loss of purchasing power long before it becomes impossible to deny. By 2026, this distinction becomes unavoidable. You'll hear talk about economic resilience, soft landings, and policy success. At the same time, you'll see gold refusing to fall and silver stubborn to stay quiet. That disconnect tells you everything. It tells you the system is holding itself together with liquidity, not strength. It tells you stability is being manufactured, not earned. Silver, in particular, sends a sharper message because it's consumed, not just stored. When silver prices rise alongside gold, it signals both monetary stress and physical scarcity. That combination is powerful. It means confidence is breaking at the same time supply chains are tightening. Historically, those are the moments when paper assets begin to reveal their true risk. This isn't about speculation. It's about preservation. Gold and silver don't care about interest rates, elections, or forecasts. They respond to math. And the math says currencies must lose value to sustain the system. That loss doesn't happen all at once. It happens gradually, then suddenly. So when you see gold and silver moving in 2026, don't celebrate the price. Question the currency, because the metals aren't warning you about opportunity, they're warning you about reality. The financial system looks calm on the surface because it has been engineered to look that way. Volatility is managed, liquidity is injected, and confidence is constantly reinforced through language. Words like stability, recovery, normalization are used as if saying them often enough makes them true. But beneath that surface is a structure that is more fragile than most people realize. And 2026 is shaping up to be a year when that fragility can no longer be hidden. The modern financial system is built on leverage, stacked on leverage. Debt sits on top of debt. Derivatives sit on top of that debt. And promises are written against assets that no longer exist in physical form. As long as trust remains intact, the machine keeps running. But trust is not permanent. It depends on belief. Belief that counterparties will perform, belief that currencies will hold value, belief that central banks can always step in and fix the problem. History tells us that belief always lasts longer than it should and then disappears faster than anyone expects. What makes this cycle different is not human behavior. Human behavior never changes. What's different is magnitude. Global debt levels have crossed into territory where they can no longer be resolved through growth. The only options left are restructuring, default, or devaluation. Of those three, devaluation is the least politically painful in the short term. And that choice leaves fingerprints everywhere in asset prices, in living costs, and most importantly, in the growing gap between financial markets and the real economy. By 2026, that gap becomes harder to explain away. Markets may still rise, but fewer people will feel wealthier. Employment numbers may look strong, but job security will feel weaker. Savings may exist on paper, but purchasing power will continue to shrink. These are not signs of health. They are signs of distortion. And distortions always resolve. One way or another, gold and silver act as mirrors to this imbalance. They don't predict collapse. They reveal stress. When metals remain strong during periods when everything is supposed to be fine, that tells you liquidity is masking risk. It tells you that the system is surviving because it's being supported, not because it's sound. And systems that require constant support eventually reach a point where support loses effectiveness. Another critical element is counterparty risk. Most people believe they own what their statements say they own. In reality, much of modern wealth exists as claims on institutions, claims on markets, claims on future future. Those claims are only as good as the system backing them. When stress increases, access matters more than valuation, liquidity matters more than yield, and certainty matters more than return. This is why 2026 is not just another year on the calendar. It represents a convergence, rising debt, servicing costs, aging infrastructure, geopolitical tension, and declining trust in institutions are all feeding into the same outcome: reduced confidence in paper promises. That doesn't mean everything breaks at once. It means the margin for error disappears. When that happens, the illusion of stability fades, not in headlines, but in behavior. People become more cautious, capital becomes more selective, and assets that exist outside the financial system begin to matter again. The exposure of this illusion won't be dramatic at first. It will be subtle, then sudden, and by the time it's obvious, preparation will no longer be an option. Only reaction. Silver has always been misunderstood because it refuses to fit neatly into one category. It is treated like a commodity when it suits the narrative and ignored as money when that becomes inconvenient. But history is very clear. Silver is monetary first and industrial second. That distinction matters enormously as we move toward 2026 because it explains why silver behaves the way it does when systems come under pressure. Unlike gold, which is almost entirely held for preservation, silver is consumed. It is used up in electronics, energy systems, medical applications, and infrastructure. Once it's used, much of it is gone forever, dispersed in ways that make recovery uneconomic. That means supply is not just limited. It is constantly shrinking. At the same time, above-ground stockpiles are far smaller than most people realize. For decades, silver demand has quietly exceeded new mine supply, and the gap has been filled by drawing down existing inventories. That is not a sustainable model. When confidence in currency is high, this imbalance can be ignored. Paper contracts substitute for physical metal, and price discovery happens in financial markets rather than in the real world. But when confidence begins to weaken, something important changes. People don't want exposure. They want possession. And silver, because of its accessibility and affordability relative to gold, becomes a natural bridge between the monetary world and the real economy. This is why silver tends to lag at first and then surge. In the early stages of monetary stress, capital moves into gold quietly. Silver stays restrained, often frustrating those who don't understand its role. But when the shift becomes broader, when individuals, not just institutions, begin protecting purchasing power, silver demand accelerates rapidly. That's when the dual nature of silver becomes impossible to suppress. By 2026, silver is likely to face pressure from both sides at once. Monetary demand will rise as trust in paper assets erodes. Industrial demand will remain strong as energy transition projects, technology infrastructure, and electrification continue to require silver in large quantities. These forces do not compete with each other, they compound, and when supply cannot respond quickly, price is forced to adjust. What makes silver particularly revealing is its volatility. Silver doesn't whisper, it shouts. When it moves decisively, often catching markets off guard. That volatility is not a flaw. It's a signal. It tells you that pricing has been artificially constrained and is now attempting to reconnect with physical reality. This is also why silver exposes weakness in financial structures. Large volumes of silver trade as paper claims, not physical metal. In times of stress, that leverage becomes a vulnerability. If even a small percentage of participants demand delivery instead of settlement, the system tightens rapidly. That's when confidence gives way to urgency. Silver's message in 2026 won't be subtle. It will say that the monetary system is under strain and that industrial scarcity is no longer theoretical. It will confirm what gold has already been signaling, that trust is fading and real assets are being repriced. Those who understand silver don't chase it. They respect it. They recognize that when silver finally asserts itself, it is not creating a trend. It is revealing a truth that has been building quietly for years. Oil is often treated as if it's just another commodity, something that rises and falls based on supply reports or short-term demand cycles. But oil is far more than that. Oil is energy, and energy is the foundation of every economy. When oil moves, it doesn't stay confined to one sector. It ripples through food prices, transportation, manufacturing, and ultimately the cost of living itself. That's why oil is one of the most honest indicators of inflationary pressure in the system. For years, oil prices were artificially restrained. Investment into exploration and production slowed dramatically, not because demand disappeared, but because capital was redirected, discouraged, or regulated away. At the same time, policymakers promoted the idea that energy abundance would come easily and cheaply through alternatives, but energy transitions are slow, complex, and capital intensive. You cannot starve an essential system of investment for years and expect stability. As we approach 2026, that underinvestment is becoming visible. Spare capacity is thinner than headlines suggest. Supply chains remain fragile, and geopolitical tensions have introduced uncertainty into regions that matter most for energy production. Oil doesn't respond well to uncertainty. It prices it in. When oil prices rise alongside gold and silver, that's not coincidence. It's confirmation. It tells you inflation is not being driven by consumer behavior, but by structural constraints. You can raise interest rates to slow borrowing, but you can't print oil. You can manage expectations, but you can't regulate scarcity out of existence. Oil's role as an inflation transmitter is critical. Higher energy costs push up production expenses across the board. Those costs are passed on to consumers, reducing purchasing power even if wages rise. That's how inflation becomes embedded, not through one-time price increases, but through sustained pressure that works its way into every layer of the economy. This is why oil sends such an early warning. It reacts before the data catches up. Long before inflation is acknowledged, oil has already moved. And by the time policymakers respond, the impact has already spread. In 2026, oil is likely to reflect the same forces driving gold and silver: currency dilution, supply stress, and declining confidence in centralized control. But oil adds another dimension: necessity. You can delay buying a new phone. You can postpone discretionary spending, but you cannot opt out of energy. That makes oil uniquely powerful as both an economic and psychological signal. When oil prices rise in this environment, it doesn't just hurt consumers. It exposes policy limits. It shows that inflation is no longer something that can be fine-tuned. It has momentum, and momentum in inflation is difficult to reverse without causing significant damage elsewhere. Understanding oil in this context changes how you view the future. It's no longer about short-term price moves. It's about recognizing that energy scarcity amplifies every weakness in the system. And when energy begins to reprice, it confirms what precious metals have been quietly telling us all along. The cost of maintaining the current system is rising faster than the system can sustain. When inflation becomes structural rather than temporary, the behavior of assets changes in a very predictable way. Paper assets begin to depend entirely on confidence and liquidity, while tangible assets begin to assert their independence. That separation is subtle at first, but by the time it becomes obvious, positioning is no longer easy. By 2026, this divergence between paper promises and real producers is likely to be one of the most important dynamics in the market. Oil stocks sit at the center of this shift because they represent something the financial system cannot manufacture: real energy extracted from the ground, delivered into the economy. These companies are not valued on hope or future projections alone. They generate cash flow from a resource that is essential and scarce. In inflationary environments, that distinction matters more than any valuation metric. For years, energy producers were treated as expendable. Capital was pulled away, expansion was discouraged, and returns were compressed. That created a leaner industry, one that learned to survive with discipline rather than excess. Now, as energy prices rise and supply remains constrained, that discipline becomes an advantage. Cash flows strengthen not because companies are taking more risk, but because the world needs what they produce. This is where oil stocks separate from the broader market. While many companies struggle with rising input costs, shrinking margins, and weakening consumers, energy producers often benefit from the very pressures hurting everyone else. That doesn't make them immune, but it does make them different. And in times of systemic stress, different matters. Another key factor is dividends and real return. In inflationary periods, nominal gains mean very little. What matters is purchasing power. Companies that can pay sustainable dividends from real profits provide something rare, income that adjusts with inflation rather than being eroded by it. That's why resource producers have historically played a critical role in preserving wealth during currency devaluation cycles. By 2026, investors are likely to become more selective. Broad diversification into everything will no longer feel safe. Instead, capital will gravitate toward assets that are understandable, necessary, and difficult to replace. Oil stocks fit that profile. They are tied to physical reality, not financial engineering. This doesn't mean speculation disappears. It means the rules change. Growth stories lose their appeal when capital is expensive and demand is uncertain. Tangible producers gain relevance because their value is visible and immediate. They don't rely on future innovation to justify today's price. They rely on today's output. What's most important is what this shift says about the system as a whole. When markets begin favoring producers of real goods over creators of financial products, it signals a loss of faith in abstraction. It tells you that investors are no longer comfortable trusting layers of promises. They want exposure to what exists, not what is assumed. Oil stocks, in this sense, are not just investments, they are indicators. They tell you that the cycle has turned, that scarcity is being repriced, and that tangible value is reasserting itself. And once that process begins, it tends to persist far longer than most people expect. 2026 is not about getting rich quick. It's about staying solvent. It's about staying liquid. And most importantly, it's about staying in control of your future. In a world where control is widely slipping away from the institutions that once claimed to guarantee it. If you understand what gold, silver, and oil are signaling right now, you're already ahead of the crowd. And in the years ahead, that understanding won't just be valuable, it will be essential. Because when the noise fades and the dust settles, real money, real energy, and real assets are what remain.